David Kelly, there are a couple hints of dovishness, if you want to call it that, in this decision. Interestingly enough, Esther George dissented in favor of a smaller increase. We tend to think of her as somewhat more on the hawkish side, but she only wanted a half-point hike. And the median Fed official sees the rate at 3.8% at the end of next year. And you could argue maybe the market had actually gone a little higher than that.
A little bit, but the markets moved very fast in the last few days, even as the Fed officials are putting in their forecast. So I think it was a given that the market was going to be a little higher than the Fed today. But I think it's really interesting that Esther George, who has, as you say, a long-lived reputation of being a hawk, recognizes perhaps that the Federal Reserve is about to make its typical mistake of waiting too long and then doing too much. And when it comes to credibility, it's really important they don't overdo this here, because I think that by the end of the year, they're going to have to be singing a significantly different tune. And I'd rather not see that, to be honest.
John, let me ask you to respond to what David just said, waiting too long and doing too much. John says that there are already signs of a dramatically slowing economy baked into the cake, and this is going to be the cherry on top, I suppose, and not in a good way.
Yeah, I think that's the risk. The Fed is clearly responding to last week's CPI print. That was higher than expectations. Prior to that, all the guidance had been for 50 basis points. You get a high CPI print. Now they're doing 75. The risk is CPI, at least parts of it, tend to be backward looking. The shelter components in particular reflect changes in house prices and rental prices that happened months ago. I think what we all know is what's happening in the housing market right now is substantially different than what was happening at the beginning of the year. Mortgage rates are higher. Every indicator of housing activity is turning. You saw that in the National Home Builders Survey this morning. Home sales, home starts. We're going to see a pretty sharp turn here. And so the risk is that they're responding to a backward-looking indicator in CPI, and those more forward-looking indicators do signal a turn in activity and probably in prices. And I think that generally is the risk that they face. So I just want to echo. I find Esther George's dissent interesting. I hope she'll explain that in a subsequent piece. That is a little bit unexpected. But I'm very much with David that the risk here is that they're responding to backward-looking indicators where the forward-looking indicators actually suggest something different.
Let me ask you, Mona, the Fed sees inflation at 5.2% at the end of this year and at something about 2.6% at the end of 2023. You think they can get that?
Yeah, I think all of my colleagues here have highlighted it really does come down to the inflation and inflation expectations. The Fed, I think, is reflecting what we did see this past Friday, where headline CPI came in well above expectations, and they moved that up to 5.2%. Interestingly, core inflation, of course, excluding food and energy, was lower, 6% in the CPI print, trending downwards. And I think that's reflected as well. I think they do think they can get 2.7% next year. Keep in mind, the Fed actions really do impact core. And two trends we've been seeing, one that John just highlighted, cooling housing market, but the other one is a potentially cooling labor market. We've already started to hear technology companies having layoffs. Over time, that will impact not only the unemployment rate, but the potential wage growth that we've been seeing. So as the Fed has been indicating, as we've been saying here, I think generally by the end of the year, we should see moderating inflation. And that will really be this cycle's Fed put. The Fed can then go at a more gradual pace. They won't back off until inflation starts to come back towards their 2% goal. But if they start moving at a more moderate pace, I think that's really when market sentiment can turn in a more meaningful way.
Shepard Smith here. Thanks for watching CNBC on YouTube.